Hi there guys, Andrew Baxter here and welcome along. As you probably realise, through Australian investment education, for almost 18 years now as a market professional and trader, I've had the opportunity to empower literally thousands and thousands of everyday people on how to successfully trade markets. Now my latest project is one that I've really found fascinating, and having been around markets for such a long time, the question always comes down to one thing. How come some people succeed as a trader and others don't? If you like, it's the tale of two traders, trader A, trader B. And what are the things that those people do differently? Well, we all look at the same markets and we probably use the same charts, the same analysis, and maybe the same trading instrument, but how does trader A get a better level of consistency in his trading? More importantly, how does he build up his success, not just over 1 or 2 weeks or 1 or 2 months, but year after year after year? And it comes down to something very simple. It's process and structure. You see, whenever the process is right, the results always follow. And one of the typical questions I've probably received more requests from over recent years than any other area of markets is when to make that decision to trade a bigger trade size, or better yet, when to take lighter positions in the market. You see, all too often we can get that gut feel to make the decision on how we're going to increase our weighting in the market. Hey, you know, my trading feels like it's going quite well just now. Maybe I should take a second or third contract, or maybe increase the percentage exposure that I have on any given trade. But that's just a gut feeling. And unfortunately, a gut feeling is something that can really move around depending on our state of mind, how we feel, whether we're tired, whether we're excited, etc. In other words, there's no process or structure behind that. Instead, we've got to find a way that just about anybody that's watching this can really follow and implement to get that structure and consistency in their decision making. So I'm going to show you a trader's tip right now. And this is just one of the tools that I use and I've used for many years. I want to share this with you and you'll see just how powerful it can be when you have a process in place that makes that, if you like, making the decision that much easier. So let's try this and have a look. What we're going to do, and hopefully as part of your trading business, and I use the term business by the way, not hobby, because business is supposed to make us money, hobbies cost us money. So we're talking about a trading business here. One of the key things that I hope you do, and if you don't, maybe you need to do this from this day forward, is to really work on your record keeping. How you keep details of the trades that you've been involved with, the profit and loss on those trades. Because it's very, very important. It gives us a central reference point to very readily be able to see our performance in our business as a trader. And more importantly, to be able to evaluate our effectiveness of the trading plan that we use. Trading successfully, by the way, and we'll come onto this as maybe part of a series over the next few days, trading successfully is about two things. It's having a process, and then it's having the confidence and discipline to follow that process. Today, let's look at a process that we can all use. So within Excel, perhaps you've created an equity curve of your trading history, and perhaps that curve may look something like this, that has periods of strong performance and then periods of less strong performance. And that would be typical of pretty much most traders out there. If you ever see an equity curve which is the bottom left to top right, be very careful because frankly they just don't exist in the real world. So what are we going to do with this? Now remember, this is our cumulative, we should put some labels on here, this is a cumulative profit on this scale here that we're measuring, and obviously this is our trading history going this way. And obviously the more information you've got, the longer history you've got, the more confidence you can have. And one of the tools I like to use to know when I'm going to leverage up and add to my positions is really quite simple. And again, it's a great reason for using Excel for this. What I like to do is overlay a moving average on my equity curve. Very simple strategy when you think about it. And let's say we use, say, a 13-period moving average. And that might be following our equity curve along like this. Now, if we draw our attention to this area here for a moment, what we can see is the performance of our trading has actually punched up through our equity curve. Now when I see this sort of thing happening in my trading, we're going to use this as an increased position size signal. So let's just say you normally risk, say, 1.5 or 2% per trade on your account. Now in this situation here, when you've had this breach through that we can see here, that's the time to really start to leverage up, because clearly you're reading the market well, and that's the time that you really want to wring the last drops of profit out of this. So this you might increase from say 2, move up to say 3%. If you're already trading at 3, or this trend of outperformance continues, maybe you move from 3 to 4%, and so on and so forth. And you can see that our moving average starts to hug until we get to our breakdown over here. Now you can probably see where we're going with this. Right now what we've got is a signal here where this is where we're going to start to reduce our position size. So perhaps through here we might be trading up at say 3.5 or say 4% of our account on any one trade. And as soon as we have this breakdown through our moving average on our equity curve, perhaps here we might drop that to 3 and then down to 2%. Or if you're really having a difficult time in markets, maybe right down to 1%. Now you might say to yourself, well look, if I'm having a difficult time, I'd just stop trading. The problem you've got then is that you start to run out of momentum. I don't know if you've ever had the misfortune to break down or be with somebody that's broken down and you start pushing a car, but when the car is stationary, actually getting that initial momentum to get it moving along is very, very difficult. As soon as you've got it moving, it starts to be a lot easier to keep it going. Now in this instance here, we never truly want to stop trading unless we've had what we call an airbag moment. That's something that's slightly different. But if we're in a situation where we're underperforming, we just drop our weighting, so we're still live in the market, we're still taking live positions, but only with a minuscule amount of risk, thereby keeping our momentum up, if you will. And by following your equity curve through in this way, you find that you give yourself a very, very structured way of knowing when to increase, or indeed, when to decrease your position sizing. Now here's the question. In that case, is this just cumulative profit? Is it in dollars? And most people that have perhaps tried to do a technique similar to this in their own trading, it becomes very distorted when you talk in dollar terms, because as soon as you start taking bigger positions, the profit or loss gets amplified in terms of overall dollars. So instead, when you're creating this kind of chart, if you're trading foreign exchange, then you should be charting this in the number of pips profit. That doesn't matter if you're trading $1 a pip or $10 a pip or $100 a pip, what you're going to see is the same effect. You're going to be able to assess your profitability of your trading, and it won't be influenced by having too heavy a position. Equally, if you're someone that trades indices, perhaps you trade E-minis, in this case, you might trade and include points as your point of reference over here. Now this may seem super simple, and that's the whole idea. Very often, the most simple things that you can use often give you the best results. And this is just a classic trader tip that I've done for years because I've been a professional trader now for many years. But don't underestimate simplicity. One of the great quotes in Steve Jobs' biography is simplicity is the ultimate in sophistication. And unfortunately, perhaps out of ego or intellectual challenge, we can look for things that are more complicated to give us a result. This is fairly simple, and it will give you a result because it will achieve one of the key objectives as a trader that you want. Having the confidence and discipline in a process structure to be able to know when you should be taking a decision to increase your position size. It's not gut feeling, it's not sucking the thumb and working out which way the wind's blowing today. It's actually having a structured approach like this that will help you become more successful as a trader, both in terms of consistency and of course in terms of your overall profitability. So if we were looking at the tale of two traders, Trader A and Trader B, Trader A definitely would be using a process like this, and I can't encourage you enough to do the same thing. Simple tip, don't underestimate how powerful it is. Put it into practice, maybe pull up your equity curve, and hey, if you don't have an equity curve, now's the time to start creating that because it's such an important part of your trading record keeping. You must be able to pull together an equity curve. We're going to pull together over the next few days a bit of a series of some of these trader tidbits to help give you some flesh on the bone, if you will, to be able to build your trading business. Not just based in any old way, but based on the success principles of Trader A. The person that has structure in place, the person that has confidence, and the person that has discipline. Because those three things I can absolutely guarantee will assure you success in the market. Hope you found this useful, and I look forward to seeing you in the next training session.